Informed Choice Radio, episode 509, helping you buy your first home with Matthew Addison from StepLadder.
Live from Sundial House Studios, this is Informed Choice Radio. Want to make the most of your money and your life? You've come to the right place. Now, here's your host, Martin Bamford.
We all know just how challenging it can be for a first-time buyer to get on the property ladder today. But what if a solution that's used in countries across the world could help buyers here in the UK? My guest on the podcast today is Matthew Addison, CEO and co-founder of StepLadder. Communities around the world have used the approach we're talking about today for decades to reach their savings goals faster. Some communities call it partner, others call it a Chit Fund. But in essence, it's a way to support each other towards your savings goals and hopefully get there faster. Before we get into our conversation, I need to give you the usual disclaimers. Our discussion today is not a recommendation to use a specific product, simply something I wanted to explore in this podcast after hearing about it on the radio a few weeks ago. StepLadder members are not covered by the UK's Financial Services Compensation Scheme, the FSCS. Therefore, your capital is at risk. So here's my conversation with Matthew Addison from StepLadder in episode 509 of Informed Choice Radio. Perhaps we can start with an introduction. Tell us who you are and where you're representing and who you're from.
Absolutely. My name is Matthew Addison. I'm one of the co-founders of StepLadder. StepLadder helps first-time buyers get on the property ladder. We help them navigate the entire journey from the point where they're still trying to build a bigger deposit all the way through the buying process. So you could think of it as a little bit of a cross between an old school building society and the NCT for first-time buyers.
Fab. And this, I'd not come across this model before. I only heard this a few weeks back when I heard a radio episode. And to tell us about the model, because the model is fascinating, isn't it? It's something a lot of people, I'm guessing, wouldn't have heard of.
That's a great question. You know, one of the things I really enjoy is taking something that actually is really familiar. It's just not familiar in this digital format and in this regulatory structure that we have around the business, but it actually is recognizable as kind of the origin story for things like our building societies here 100, 150 years back. And so one of the things that we're doing is we're taking that and making it digital. And we're also tapping into a generation today that is more likely to be social about their relationships, about their fitness, about their healthcare, and also about their money. And so we're bringing back a lot of those features of the local building society, but doing it in a digital and scalable way. And these are actually very widely used around the world. And so it's also about matching people up to the right name that they might know it by. And that's one of the most engaging parts of the conversation when we meet a new member is they're like, oh, but where I come from, we call them, whether it's a consorcio in Brazil, a Tanda in Mexico, a Chit Fund in India, a committee in Pakistan, or an Ajo in Nigeria. There's recognizable names for these in so many different communities around the world. And what we're doing is we're bringing it in a scalable way, in a digital way for a new generation.
And interesting that this has, until now, not really been a feature of the UK financial services landscape, but certainly it's been taking place in certain communities within the UK, I think it's fair to say. So why is it something that didn't evolve until now, until we've had this option to make it digital within the UK space?
That's a really good question, and something that I'm often asked because, well, maybe we're path dependent and we don't recognize it more. But again, building societies very much started this way, or credit unions have this mutuality. And so mutuals represent in financial services a much bigger share of the marketplace than is often looked at first glance, certainly compared to, say, fast-moving consumer goods. And so in that sense, they are here and they've been with us the whole way. What has evolved over time, especially because of a consolidation of these different operators, has been this breakdown in the community-ness of them. And so when I go and meet with branch managers of one or two branch building societies, they immediately recognize the similarity in our core offering with what they started as themselves. Imagine a building society where instead of having a branch, you have a digital platform. And instead of having to constantly run, every member who joins plans to both borrow and save the same amount over the time that they're committed. And that's what creates the structure that allows us to make this so scalable, is the fact that everyone who joins sees themselves as both the person who's setting aside money in a reasonably disciplined and committed way, as well as being a person who ultimately is going to borrow that same amount.
That's interesting, and possibly something that's become slightly disconnected within modern banking, because we understand that banks are about lending money to people and also taking money in as deposits, but it's almost lost its context in a way with the rise of noughts and ones on a screen. Banks can take money as deposits and then they can lend, 10, 100 times that amount out. So this is taking it all the way back to how it used to be.
Yeah, for your listeners, I'm like nodding my head vigorously as we're talking, because you're exactly right, Martin. The thing that I think is really powerful about this is if you can think about it as the thinnest bank you could possibly have. What we do is we act a lot like the admissions department of a university. We make sure everyone who joins the circle meets the affordability to be able to make that commitment under reasonable circumstances. We make sure to provide the administration, the infrastructure, but otherwise we're basically tightly linking both the left hand and the right hand side of the ledger.
Yeah, and it's fair to say, I think that this is mostly for first-time buyers, so people who are trying to get onto the property ladder, hence the company name StepLadder. So talk us through, Matthew, the typical experience for a first-time buyer who comes to you and joins in with this type of lending.
That's a great question. And right now what we've really seen, and again, I described it earlier as kind of a cross between financially the building society model or certain elements of it, but also the NCT. The idea is that the first-time buyer today is spending 6 years of their journey saving up their property deposit. And while they're on that journey, all they're focused on is the bank account growing. But what about the preparation for the buying process itself? What about having someone on your side when you come to the process of buying and making sure the jargon can be disambiguated? How about showing or creating some sort of framework for the commitment of putting money aside regularly? So a typical member of ours would be someone like Ed, who essentially had never really been able to consistently set aside money every single month, even though he's a great earner in London, works in the same industry we do, of fintech, and yet at the same time, having something where there's a direct debit every month of a certain amount, and then when he translates that into the lump sum because he draws, he knows that he sets it aside into something like his lifetime ISA. But if it had been a small amount every single month, it would kind of ebb and flow because it was in the same bank account. And so creating that structure, that discipline, is a little bit like joining a running club when you're going to go out for a marathon. It increases your likelihood of success. It creates a structure so you can do it in a healthy way. And it also makes sure that you know that you're not alone in preparing for that big hurdle. And so Ed's a really great example of people who we meet at our earliest stage in the journey, mid-20s, someone who's setting aside 100 pounds, 250 pounds a month. We also have members who are close to the buying process itself, someone like Amish, who was our first member to draw back all the way in 2018. And Amish's story is fascinating because he was a really disciplined saver from his salary. He lived at home with his parents, and his parents, the bank of mom and dad being such a big part of the picture for most first-time buyers' deposits, were tapped out in terms of what they could contribute. So he needed just a little bit more. He was saving about 40. He had 20 himself already. His parents could kick in 10. And over the period of time they could kick in, they want to see that he put another 10 in himself. He joined our £1,000 a month circle. When he drew, what he also had from us was help with navigating the mortgage process, in finding the right conveyancing solicitor and saving some hard-earned money in that purchasing journey because of group buying discounts. And so the whole idea was, it's not just a piggy bank. It is also something like the NCT, showing that you're not alone in that journey, and then especially benefiting from the fact there are so many people who are going through that with you, that you can actually get some real economies from that collective buying. And that's one of the things that we think is really powerful for a lot of our members, is having the right kind of support for their specific journey. And so Amish was our typical example of a member who's buying out in Slough, and he ended up being able to be a buyer. And in fact, he still continued to come back to us for support long after his circle ended. And the buying process was one that took a little bit longer than he originally planned. And so the whole thing is this idea that you join a members club, you have this support from StepLadder. And so it's much more than just a financial product. It is a community.
And you mentioned they're a circle. So how does the circle work? How many people are involved in that? What are the mechanics behind it?
That's a great question. So you got the right co-founder on this call, because I'm kind of like I'm like the gearhead. I want to talk about what's underneath the bonnet as the engine of the car, and not the whole car itself. The simple answer to that is that every member makes a subscription commitment. And so that would be, let's say, £1,000 for 10 months, and you're matched to a group of 9 other people who are making the same commitment, and you all start off on the same day. What we basically do is we have a direct debit set up with all 10 of you, and the 1,000 is called from each one of your personal bank accounts when you set that direct debit each month on the first of the month, and 10,000 is collected between the 10 of you, and that's allocated by random draw to one of the 10 of you. That repeats for 10 months. So ultimately the point is that each individual will take out exactly what they've put in, but collectively, instead of having to wait 9 months to get 10 grand together, there's 10 grand available each month between the 10 of you, and that can get allocated to one member. And that is at the core of it where the magic lies in terms of being able to help people raise their deposit faster than they might have saving for themselves without changing their cash flows at all.
So worst case scenario, you'd have to wait to the end of 10 months, but there's a possibility of, actually, I'm doing the stats in my head at the moment, there's a higher than average probability that you get it faster than 10 months.
90% likely.
Yeah.
And your worst case outcome is no worse than doing it by yourself.
I can see the attraction already. He's so different to the way that first-time buyers would typically approach getting onto the property ladder. So what's the response been to this so far? You know, what's sort of, you've mentioned a couple of examples there, but sort of the stories you've heard from people who are desperate to get onto the property ladder.
Check our trust pilots, because there's nothing that makes me happier than being able to see the experience of our members and hearing how much we can support them from the journey. I came into this, to be honest with you, as a finance guy with 20 years in the city, working in investment management, doing structuring and credit analysis, all that you want in the plumbing and making sure the engine works right. But to hear the experience of our members being much more about having someone on their side in the journey and seeing tangible examples like Shanae, our first member to buy our house back in October of 2018, one of the things that was fascinating was not so much the fact that we helped her in terms of finding the right mortgage advisor, which ended up helping her a lot, or the right conveyancer, which again helped her a lot. It was actually at the point where she was offered insurance. Typically, and this is a financial advisor, term life insurance is a pretty standard offering, as is income protection insurance, which in its own way led to a bunch of other issues. And so she was trying to deliberate this because the first time she had ever had to deal with this particular question herself. And typically for a 26-year-old earning well, the idea of going out of your way to particularly insulate the bank from its risk isn't the sort of thing that you would say is the highest priority for someone who's trying to make trade-off decisions, right? But in Shanae's case, she has a young son, Jaden. And one of the things we talked a lot about were the circumstances in which something happened to her. What would be the time that her family needed to make arrangements for Jaden? And so the conversation with her is very much about her bespoke situation at that point with something that she was unfamiliar with and that was very specific to her case. And so in the course of an hour or two, we could help her ask questions of her mortgage advisor, because that's obviously a separate business from us, but also to think through her own family situation in a way that she might not have if she were just served up the offer of these two boxes to tick. Do you want to take insurance? To think about her own situation, what questions she should ask herself about the trade-offs involved. And the result of that was that she walked away from the conversation with StepLadder supported through the whole buying journey, not just setting aside funds.
This is a financial product, so of course there are charges involved and there's also risks involved. So perhaps we start with the charges. And what does it cost somebody to become part of a circle and take advantage of that model?
So if you're setting aside £1,000 a month with StepLadder, we typically charge somewhere about £20 to £30 a month alongside, and we do that every month that you make your payment in. So all told, in the process of raising 10 grand, it's going to cost you 300. That allows us to recover the cost of delivering you a service, things that we have in terms of infrastructure in the back end, the credit check costs, et cetera, et cetera. But the idea is that we're not making a margin on you from that fee, but that does allow us to recover the cost of delivering you service, our regulatory reporting costs, all the other good stuff. But where we do start to have the potential to make a profit is if we can introduce you to someone who ends up helping you, like a mortgage advisor, which would be a separate business, or a conveyancer, and they end up giving you the best price you can find. Great, because we'll also make a referral fee. But I believe in not tying anyone who works with any of our members to any of the services we offer. We offer them, and we offer some really, really good discounts, I believe. But at the end of the day, you're free to choose whoever you want. So if you have an uncle or aunt who's a surveyor, use them. That's great. You're not going to get better rates. But if you don't even know where to start, and we've been with you for 7, 8, 10 months of your journey, then we're a pretty good place to start. And on top of that, you get the economies of scale of many, many of our members, and therefore better rates.
And then what about the risks involved? Because the cynic in me is thinking, well, I join a circle with 10 people and people get paid out in months 1, 2, 3, etc. What's their motivation to keep paying in over that time? What ties them in? So is there a risk that other members of the circle step away early?
So our main value added in terms of facilitating this, and one of the things that we talk about a lot with people who do these informally, and some of their horror stories, is the fact that the operator has to go chasing people down. Well, our job, by setting up the direct debits ahead of time, by running the affordability, just like a mortgage lender does, we do the credit underwriting at the point where you apply. We know that you can set aside this amount every month. Plus, we have a bunch of mechanisms built into the offering itself that act as buffers. For example, we don't do the draw after the first month, but after the money's collected on the second month for that group of 10. So there's a little bit of a reserve period. We know that you know what you're setting aside money for. We also, at the point where before you've drawn, give you flexibility to drop out. What it means is that you go to the end of the queue. So you become the 10th person, but instead of getting the full 10 grand in our example, you would get the payments that you made up to that point in time back. And that acts as a really good flexibility feature up to the point where you've drawn. Once you've drawn, one of the things that we do to make sure that all members are protected is that we only release the funds at the point where you're ready to exchange, and we release it to your solicitor for the property deposit. So the cash becomes bricks and mortar, which is a lot harder to run away with. Mm-hmm. So we don't put it into your bank account tempting you, exactly going back to our conversation with Ed, where it becomes a sports car or a holiday. Instead, it's only used for that purpose. And that gives a lot of risk mitigation. Finally, and this is important, when we talk about the use case of home ownership, there is that equity in the house. So in a worst case scenario, we could talk to you about some sort of workout from that property. But the reality is we haven't had any experience of defaults yet, even through the COVID period. And one of the reasons for that is that we're really conservative upfront in our underwriting, everyone, to make sure that we're comfortable with responsible lending, both as you're setting aside money and as a borrower from the group.
I was going to ask about the impacts of COVID-19, because clearly we're in recession now. We don't know how deep and how long that's going to be. We see headlines every day about job losses, about incomes being cut, people going down to 80% of salary because they're on furlough. So what have you seen within your circles in terms of the economic impacts of COVID?
That's a really great question. One of the things, so we're now coming up in September on our 5th draw post the COVID period beginning. And over that period of time, we've had less than 25 basis points of arrears in our group. And so if you were to benchmark us versus even the numbers you're hearing about provisioning at the neobanks or especially at peer-to-peer lenders, I mean, it's a completely different category. And the reason is that what we've really built is a mechanism to allow people who have the budget to set aside the money. And if their circumstances change, the flexibility to drop out without affecting others who are setting aside that money. The key thing, the key power of it is this idea that each group is self-contained unit. And if you do drop out before you're drawn, what you've been up to that point in time is a contributor of capital, not a borrower. Mm-hmm. And as a result, that flexibility means that once you actually become the borrower because you've been drawn and you've actually found your use for that funds in the form of buying the home, then the amount of payments that you have left is usually fairly de minimis. And on top of that, you have a hard asset. You have to live somewhere that you're really caring about making sure you keep making the ongoing payments, not lose it.
So for a first-time buyer who's listening to our conversation today and thinking, do I go down this route or do I do it the traditional modern way, perhaps, of doing it on my own and trying to save up enough money? What are some of the things to think about if they're thinking about going down the StepLadder route?
That's a really good question. I think the number one thing that we see most of our members deliberating on is they think of it a lot like a financial product. And then one of the things that we go out of our way to talk about is the fact that, yes, that's at the core, but the real experience of membership, and this is why I refer people back to our trust pilots, is the support. It's having other people who are on the journey with you is incredibly encouraging and frankly helps dispel a lot of the anxiety that you feel bouncing around your house yourself saying, am I ever going to get there, or with your partner. The other thing that's important is the group buying discounts, which are not available for you as a consumer on your own. So if you don't have that family member who knows that area or a very close friend to make that referral, the fact that we can serve these up and the fact that we have an ongoing relationship with, for example, the mortgage advisors that we introduce allows us to also chase them. And you say, gee, I don't get what's going on. It's gone really quiet on my conveyancing. I call up Bill and I'm like, Bill, what's the story with this? You have that lever to pull, whereas if you walk in off the street, that's not available to you. So the whole idea is to be part of a community on that very, very desolate journey of saving. And it creates an alternative to saving by finding community people who are supporting each other. And it also translates into the bundle of sticks. It's stronger together. And that translates into economics. It translates into success rates. So people who join these groups, just like the marathon runners, are 3 times more likely to reach their goal. And our default rate reflects it too. And then the final point I would say for a person considering this is just there's a lot of flexibility built in case your circumstances do change. And sometimes that's the reservation people have is like, oh my God, am I tied up in this forever? And that's one of the things that's been really positive about the COVID experience is that people whose circumstances have changed have been able to fully enjoy the benefit of our flexibility.
And the community aspect within a circle. I mean, a circle member gets to know the other circle members and they chat and they exchange progress and ideas and things.
In two different vectors. One is within your own circle where you are a real person to the other members of that group. As those individuals draw, you see so-and-so drew in my circle, and then you have a way to communicate with them. But on top of that, the community as a whole of StepLadder members. And I really encourage people to check out either our Facebook page or our LinkedIn, where you can see things like our Christmas fair, where we had members who actually have their own side businesses come in and present to each other, anything from clothing to baked goods to perfumery, because there's this idea that you're in a group together facing this overall challenge of the home buying process and with this really important life goal. And it's good to find other people on it with you. And that's one of the reasons, again, I draw this analogy that beyond a building society, there are all these best elements of the NCT.
Yeah, absolutely. Thank you so much for your time today. It's a fascinating model to learn more about and to hear the ins and outs about. How can we find out more about StepLadder and connect with you and find out more?
So joinstepladder.com is our website. We love people getting to know us over time. So if you just come in, pop in your email, you'll start seeing our newsletters here after our draw day, which happens right at the beginning of every month. The success stories of our members, you can see testimonials there, as well as where we share a lot of the information, knowledge, insights about things that are relevant for the home buying journey with our members through our blogs and our content. So I strongly recommend joinstepladder.com and then our social handles as well.
Fab. We'll make sure we put links in our show notes for this episode to the website and to the social media too. Been a pleasure chatting, Matthew. Thank you for your time.
Thanks so much for your time, Martin. This is great.
A big thank you to Matthew for joining us for this episode of Informed Choice Radio. I always love to hear about new products, new approaches to financial services here in the UK, even though in this instance it wasn't a particularly new idea. This is something that has been used around the world and also in communities here in the UK informally for decades, probably even longer than that. And as Matthew explained, going back to the original concept of mutuality for building societies here in the UK, this is something I think we've just become slightly detached from, I think, in recent times as UK financial services has developed. So a very interesting product. As I mentioned in my introduction, though, it's not a recommendation to go out and use it. Do your own research first. Make sure you understand the risks involved, the charges involved, and how it all works before you decide if it is the right thing for you. So that's my disclaimer out of the way. I'll put links in the show notes for this episode, which you can find at icradio.co.uk. Do check it out. Do find out more. Thank you again to Matthew for joining us for this episode. And until next time, I'm Martin Bamford. This is Informed Choice Radio. And remember, when it comes to your money, the more you know, the faster it can grow.